let's start off with George. George, welcome to the show. Thank you for being here.
Hey, thank you, Michael. A pleasure to be on the show.
All right. Give our audience a background on who you are, how Arel Capital got started, because I know that you've got some real power players behind you in this company, and then where we're going with your real estate ventures and how you see that industry sector evolving from this point forward, if you would.
Great. Thank you, Michael, and again, a pleasure to be here. Well, listen, the company is called Arel. It's a kind of quirky name. Arel was formed by two longstanding former Wall Street professionals in early 2013. And we call it Arel because the managing partner and really the main founder of the firm is Richard Leibovich, a guy with a long history at J.P. Morgan and Putnam Investments, and then where I worked and became a partner with Richard at a fund of hedge funds called Gotex Fund Management. So it's RL, Richard Leibovich. It's his initials, and he never wanted it to be confused with the more famous Ralph Lauren, I guess. But we were formed originally as a family office, really to cater to the wealth that was generated from our experience in the financial markets. The partners at RL retired after the 2008 downturn. We all worked to keep our former hedge fund operating after we took it public and after that downturn. And we really were just managing our own capital when a bunch of our former hedge fund and finance colleagues started to call us up and wondering, well, since we were on the sidelines and not in the quote-unquote market, what were we doing? And we were investing in real estate, and specifically in multifamily real estate, apartment buildings and garden-style communities in large markets around the country. And what was attractive to us to go in and start acquiring real estate for our own family office and then for our colleagues was that we really felt that multifamily real estate assets could provide very strong value protection in cyclical and inflationary environments. We felt that in long term, there was no secret that owning real estate was one of the most conservative and safest asset classes that you could put your money in. But a funny thing happened on the way to creating a family office or even retiring. Our family office quickly started gaining some popularity within the financial professionals that asked us to diversify them out of their hedge funds. So we evolved into a boutique real estate investment firm with a broad range of clients, not only our old colleagues, but also family offices and high net worth individuals and institutional investors, including everything from college endowments to Native American Indian tribes. And the reason was all of these investors believed that they could create very stable current income streams while having appreciation within those assets. And we thought it was just an incredible opportunity. So we've gone out there, and in a market where sovereign wealth firms and big state plans go after what we would call A-class or core real estate investments, and other investors like to speculate in more kind of government housing or more volatile C-class. RL focuses on the mid-sized real estate assets firmly in the B plus category because, again, we felt that it was the most stable and less prone to cyclical markets than any other sector in the real estate strategy.
Let me jump in there for a second.
Sure,
Being
Mike.
that you're a trendsetter in regards to finding undervalued or below replacement value properties that you can go in front, we're starting to see, and my background has really been the technical analysis in markets. So watching the bond market started to break all these lows, interest rates starting to move higher. Do you see that as the potential for a vacuum that where the A-class the investors that go into A-class may start to find your space and come in behind you?
Well, that's Michael, I appreciate that question. It's a really interesting perspective. We take a look at it. There's been an interesting lull in acquisitions in multifamily at this point. It's really interesting because the seller, the market of sales has not caught up with what interest rates are doing. And we found that there's quite a bubble because I think that you've probably, since you're into, analytical trends, you've seen the amount of capital that has been rushing into real estate, multifamily in general, but the United States on a macro level. There's been a tremendous influx of foreign investment. There always have been, but we're really at this high cyclicality of equity capital rushing into the United States as a very stable market. And interest rates rising, you'd think that, with that, prices would be falling, but we have not seen that. Mm-mm. But interestingly enough, we find that to be one of our greatest opportunity. We find it that we have a lot of dry powder and that there is a lot of uneducated capital chasing this stable asset. And really the secret to acquiring real estate and what we do is not so much what you pay for it. The secret is how well you enact your business plan in improving these assets, increasing net operating income, and then eventually being able to work through the lifespan of the investment to selling it and really seeing positive realizations from it. And in that, there are a lot of inexperienced money rushing into the United States and rushing into these kind of assets. And we feel that there may be a distressed opportunity with this kind of disconnection that we're seeing right now.
I get it. We've got about a minute left. Are there any particular cities that you're focused on at the moment?
Yes, again, a great question. We stick to large, liquid markets because really the secret to acquiring real estate is getting good financing and not over-leveraging your acquisitions, and also being in liquid markets. So we've always been in New York because that's our home, but we love Charlotte, Nashville, Charleston, South Carolina, Houston, Austin. We love Austin, and Denver, which is, Denver is no secret, but those are some of the environments that we really love. And, no surprise, we've been investing in those towns for a long time, and a few of them are on the list for Amazon to put their new headquarters and other lists of millennial growth. But we take a look at those large liquid markets, so I hope that answers your question.
It does. We've run out of time, but that doesn't mean we won't be talking to you again. George, we've got to run, but thank you for being a guest on the show.
Michael, it's been a real pleasure talking to you and your audience, and I look forward to speaking to you again.
You're welcome. All right, George Yepes, partner, Arel Capital, ARELCAPITAL.com. We'll be right back on the other side of this break with our next guest, David Nagy, Managing Director, Aperion Ventures. This segment has been brought to you by thevitaminpatch.com. You've been listening to CEO Money with Michael Yorba. We'll be right back.